Right, I think so. It's 2 o'clock. Hello, everybody. I hope you got the message. As requested in the last live show, somebody wanted to speak about some of the fundamentals. So I said we'd go through that document that I created for everyone that I'll make available for anyone that requests. You can find it on as a thread on my chat about fundamentals. The document's in there. But I think it's always useful. We talk increasingly as if everyone has the same level of knowledge about how we look at economic data and how we want to react to forex, indices, commodities, etc., and how it's all like a giant gyroscope that moves around. You can't really look at things individually, but that's how it gets built up. We'll start off with the building blocks and see how it sort of comes together. And this will take a number of sessions really, but this is going to be like an overview of how to start looking at things when you see the economic reports, because it's mind-boggling and bewildering. I know when you've got all these acronyms and the same data called different things all popping up. Hold on, we may have a problem on the feed. Hold on. Just Richie NK, while you're there, can you see, am I working? It's just I'm getting an error message from YouTube. Can you just tell me whether you can hear me and see me? Or is there anyone else out there? Can you see me or hear me, or do I need to restart this? So you can hear me, can you? We're just going to go through some fundamentals, how you should look at the data, etc. Yeah, brilliant. Thank you. Right. So just for basics, in terms of looking at a market, a stock, a price, a good, anything, it's always about supply and demand. Does everybody understand what that is? So just looking at the little graph that I put up there, you've got price and quantity on the indices, and then you've got these two curves, supply and demand. So this is what basically the markets are all about, and the data that we hear relates to either supply and demand of an individual company's goods, or what we're really looking at is the aggregate of everything. And we'll work through how that happens, but just the basic idea is that people will demand more of something when its price is cheap. So when the price is down here, you get big demand. And people who make things supply lots of it when the price is high. And then it's where they meet in the middle. We get the thing called equilibrium, price and quantity. So that at that price there, the most quantity would get produced. That's where demand equals supply. So that's just the basic fundamentals. Hopefully most of you have come across that, but if not, that's the basics of economics. Now, I don't know that any of you got a chance to look at my document, but I'll go through the things that that asks us to think about. Let me just find it. Okay. So what I said was fundamentals, coming to speed. We're faced with a world at the minute that has lots and lots of debt in it, which means that the bond market becomes very important. So as you can see on there, there's a quote from James Carville that I always use from from the 90s, which is very similar to the situation the US is in now, where they tried to make a lot of changes. The fiscal spending, what the government spends, was far too much, so they decided to rein it in. But then the governor of the bank of the Fed, Greenspan, was very worried that that would have an effect that would slow everything down too much, so he made some interest rate cuts. But basically, President Clinton and his advisor Carville were worried that they couldn't do what they wanted because the bond market put the price of rates up, made bonds go down, made it very difficult for them to sell bonds to do their spending. So they quickly realised that the bond market is so big that it dictates to everyone. So that's the reason why everybody to this day is obsessed with interest rates in terms of trading markets and how that relates to exchange rates and bond market prices, and then obviously how you value equities and indices. It's all about future cash flows and how you discount them back to present values, what something in the future is worth today. So interest rates become very important. But within that document, and this is how I was kind of taught, and this is the thing that I always have at the back of my mind whenever I am looking at things, is what is the economy? It's really all about GDP. Well, GDP is, remember, if you go back to that original graph we just looked at, the supply and demand curve, it's the aggregate of everything in the economy and the graph of what that looks like. So the demand is the aggregate demand and the supply side is the aggregate supply. So it's all about what are all the factors that make up all the demand in the market and who does that belong to. And then the supply is literally the aggregate of all the people that make goods and why do they do that and what factors may or may not affect it. So all these data points we see every day drop into any of the categories that we're about to describe. So, I mean, feel free to throw any questions in as we go, but I'll just work my way through it otherwise. So aggregate demand is the consumer, which is the C, versus investment, I, plus government spending. And then it's all about exports minus imports. What is the net trade balance in an economy? Now, this is quite interesting at the moment while the US election is going on, because if you listen to Mr. Trump, he wants to make America as much a domestic economy. He wants to stop the imports. He wants people making things in the US. So if you can look at that X minus M, anything that's made and sold abroad from the United States is the X, and M is the imports. So if GDP equals aggregate demand, which is that whole formula, if you take out the bit that's subtracting, which is imports, then you're going to grow the economy, which is his whole argument. So when he's talking about tariffs on people who won't pay in dollars, etc., then what's going to happen there is there's going to be fewer imports, and anybody that does play will have to pay a bigger price, which will help reduce that G number as well at the same time, or the total of that G number, national debt, etc., which is another thing which affects interest rates and the whole dollar. The problem with this is, and we spoke about it this morning on my daily chat, all about the wall of worry and rabbit holes. The more you look at macro, very quickly we go down rabbit holes. There's so much involved with each one that as I will go ahead and do in the next few weeks, we'll do individual either recorded videos or sessions on each individual component of these, because you could go on for hours about what makes things up. We just want to get you in the mindset of how to think about markets and fundamental data. Let me just have a look at a couple of comments. So, Ricky, will the election affect the market in general? Well, it should, but it depends what markets you're looking at. So, if you're thinking about inflation and interest rates being high, then that is why people are saying that the dollar will be strong. But in terms of indices, generally you get a little bit of nervousness going in, which releases, and then you get a decent rally afterwards. When you have situations where the market rallies strongly into elections, is normally predicting a Republican win, but history suggests that whoever wins, the markets still go higher, and it's really about having having a period of taking away the noise in the system, having confidence in just knowing what the people are in charge are going to do. The fact that someone has actually won, we get a much clearer outlook as a result of the election being out of the way. And generally, if the Democrats win, they tend to have a better first year market returns wise, but both of them will be influenced at the moment by the fact that we're in a very bullish stimulus situation and easing monetary policy. So they're both inheriting a decent outlook for indices. And then obviously the bond market will move around with inflation expectations and where the interest rates are going. David Prudvy. So sorry, OJ, I missed you. OJ, yes, you're right. Trump is leading in the polls, and they call it the Trump trade. That is coming through, and obviously there's a lot of those Nobel laureate economists against him, saying that he's going to be inflationary, talking about his tariffs. How can it not put prices up, etc. But as we know, China are on their knees, and they're going to export some low prices. So adding tariffs to low prices still might not cause that much of a problem. Hello, Plants, from David Prudvy. Never seen anyone with so much information processing. See your Discord message every day. Well, the whole point with the messages is just to get you to try and think and then come back with questions, and then you gradually build up your knowledge. With this, it's not a kind of one-stop shop. We're not going to watch this today and get it straight away. And even, as I said earlier, each of the components are an ever-learning session within a session. So it's just about, to me, trying to get you all to layer knowledge. The fact that you're looking and interested is a great starting point, and then it all just develops, and there's different ways you can go with it. And there's markets within markets, and there's markets within the data. Vinay, collect data, journal, backtest, tape read, forward test, practice what you already know, helps you understand your strategy, in turn builds your edge. Yep, that's all fantastic ideas, and you can do the same thing with the fundamentals as well as the technicals, and then the whole thing becomes even stronger. Then within that journal, within that back testing, you can find there's another overlay of why those things might be happening. Your chart could be telling you one thing, but the fundamentals are the opposite. We're really trying to find the confluences that show us what's out of line, or whether it's all systems go in line. Let's really kick on. So it's very difficult to do that blindly. You know, you're playing, your probabilities of regular success are lowered. But it's not to say you can't have good runs, but it is. It's just like seeing the full picture rather than seeing something out of focus. You're seeing it more in focus. There's no Plants. People call me Plants. Don't worry about that. Richie, it's not a problem. So we'll jump back to that. And I'll just go through a couple of little slides talking about C plus I plus G, and then I literally do want to walk you through what I've written previously, just to have a chat about it. Even though it is text, it is the way to start. And on future episodes, we'll really dive into some of the graphs that accompany it all. In fact, let's go to the third page first. So that's C plus I plus G plus X minus M. Really, I mean, all of you have that written down somewhere whenever you're doing your fundamental research, and just think today, what is actually happening? What is moving? So what are those things? C is all the consumer spending in the market. Now, it's very interesting because what that really represents is PCE, personal consumption expenditures. Now, you all might hear that a lot because PCE inflation is the Fed's favored measure of inflation. And that literally is this number, but how much it's moving by. So this is why retail sales, etc., anything that gives you evidence of what's happening to retail spending and the rate of change of that is what we're really looking for, because we know the Fed is going to base its interest rates decisions on it. So you're forever looking at it, and that can include, we're going through earnings season, you want to be all over consumer-facing big industries. Look at the big companies, look at the ones with the trends. So, for instance, you had Walmart. Walmart's last report, and we're still yet to see the next one in the next couple of weeks, was talking about trading down. They not only are seeing people at the lower end of the wage spectrum increasing their spend at Walmart on better valued products, but they were seeing the biggest increase in accounts from middle income consumers than they'd ever seen in their history. So that's a trend that you want to see, and that will be telling you that you might be getting total value of the consumer spending going up, but you might not necessarily see the price factor. So the volumes might be going up, but at a lower price. And they all give you clues as to what that PCE inflation data might look like, which is why the Fed is quite okay with the growth rate of the economy bobbing along, but they know that the price levels within it are coming down. Now, a lot of things for consumer on the street, they've gone up 20% in the 2 years since COVID and the Ukraine, etc. But they're now only going up at a very small rate. We're talking 0.1s and 0.2% per month, whereas there were 5 and 6 and some things 10% before. So there's two things to look at. There's the overall rate of inflation that's embedded in goods, and that affects people's ability to spend and whether they can borrow to loan and whether demand is going to be there. And there's a lot of evidence that demand has stalled at high prices, which is why the Fed start getting worried. But they know that the underlying inflation going forward, the rates of increase per month are slowing. So it's a two-way pull on that, but you have to think about it. Investment, that's the big one, and that's all about confidence for companies to not only invest to sell things to the consumer, but between themselves, the overall economy. So things we look at there are durable goods, the big items that you see. We talk about that, and hopefully you've all been around long enough to see my Michael Jordan image with the boots cut off, because that means he was unplayable, so there's no defense to playing Michael Jordan, and there's no Jordanaires on his feet, so there's no aircraft spending either. So ex-defense, non-air is the durable goods number that you need to look at whenever they come out. That is a proxy for business investment, and that is generally what people put in there for the eye, but literally you can get, the reason we look at ISMs and the PMIs, the purchasing managers indices on a monthly basis, is they tell us what the level of activity is like from surveys. Is it above 50 or is it below? That's whether it's contracting or expanding. And then they have these things in it, components, all about the employment bit, which we know, the prices paid, which gives slight clues on inflation, or businesses, between businesses paying a little bit more than they did last month to get the components. And then the important stuff, how you know whether there's investment is increasing or decreasing, new orders. Is the economy putting in advance orders, which means that one company's got to buy from another, and it all snowballs, etc., etc. I don't actually post on Instagram, David. We put the daily comment I put on my Discord onto X, or it's on my Discord channel, the Alpha Cat. So feel free to chat to me on there anytime, and you'll see the content. So as I said there, private investment and corporate spending, non-final capital goods. Don't worry about the technicalities there. That is literally just businesses dealing with each other and demand. And the reason why the Fed got very, very nervous is those ISMs alongside weak non-farm payroll prints in August, at the start of August, were showing you that the literal comments between companies were that people aren't investing. They're waiting for the rates to be cut. There's no new orders. People's inventories were building. Inventories are stocks that they hold. So basically, you've bought enough goods, you don't need to buy any more to sell on to the consumer, and it all kind of snowballs to slowing down the economy. And that is the problem that we've got with the ASML. If you saw ASML results this week, their end customers aren't the people on the street. They are the people who make things out of semiconductors. Intel and Samsung, now those two companies have messed up with where their strategy is, and a little bit behind on the AI game. They're trying to play catch up, but that means that they've got lots and lots of chips in inventories, and also the EV side of things. There has been a bit of demand for EVs, but Tesla and a lot of the other players in China have China chock full of their own EVs that they're trying to dump around the world. There's no marginal demand for the chips that go into automated cars, etc. So that is creating a backlog for that. Whereas if you look at the AI side of things in the US, they're all going gangbusters. TSMC, who makes the wafers for the chips, etc., they're all going absolutely crazy. So it's all about where you are. So this is where you need to look at industries within industries, as well as the underlying trends, and get to feel where the investment spend is. So there's lots and lots of AI investment spend going on, and the relevance for indices is when people say, "Oh, but you're not getting any." The people who are buying the AI stuff, the big guys in the Mag 7, they've been accused, Meta and Microsoft and Apple, of not actually making any money out of it yet, but they're all very close. And I've actually done a research note on a company at the bottom of the chain, and all the demand and monetization of AI business in terms of going into companies, improving their processes. That is going crazy, and there is a lot of monetization. So kind of ignore that. I'm sorry for having problems today. Like I said, I did get a message from YouTube that they've got an issue, so it might be that there is some form of buffering going on. Hopefully that's going to restart properly. Government spending, that literally is like welfare programs, infrastructure spend, building, the roads and all that kind of thing, Medicare, as it says there. And the way to think about aggregate demand and GDP is, how do we keep it going if one or more of those factors suddenly don't start performing? And if you think back to thank you for that comment, David, on there. That's exactly right, if we can try and stick to that. Where did I put that? Oh yeah, so if you think about situations where we've got recession or a crash, and when things really fall apart, what do you tend to see happen? You see people lose their jobs, and banks stop lending, so that C number will go down because people aren't in a position to spend, and demand goes down, and that creates a situation where investment goes down. And if you think about it, and this is like big thinking, in the GFC, interest rates went basically to zero. Eventually in Germany, etc., they went negative, but effectively think of zero. If you're a company and you're making something that people want, and you can't borrow money for free and actually make a rate of return on that, then should you really be in business at all? But a lot of people were so worried about the future that they weren't borrowing. So that meant we had C and I, and also X and M falling. What is left to keep the economy going? And this is literally what has happened to Japan for 20 years. The G has to go massive, and the G's been massive in the US as well. That's what's been creating this whole de-dollarization, because fiscal spending, the government difference between the taxes they raise and what they spend, leaves them with a hole, and they have to borrow that in the bond markets. But sometimes it becomes necessary. You have to have the G up there. Now, hopefully what we're going to see next year is the C continues going. I, by the look of it, is already starting to increase. Investments coming through, people are getting confidence. This is why I talk about growth trumps everything. If you look at the rates of returns on the individual stocks that are coming through. Remember, we've already started to see some good beats in the early part of Q3 because they've pulled down the expectation so far. This is the lowest quarter expected for the next 3 or 4. So if we're beating now, the expectation is that there's going to be real acceleration into next year. And generally, you do get a third year. Once you've had 2 good years of a bounce after a crash, the third year normally is quite good, and it should be quite good as being the first year of a new presidential situation. Plus, you've got stimulus around the world, then that should lead to seeing growth. Now, in terms of that stimulus, we're trying to see it come through as monetary policy. What we want to see is the G side of things to go down. That's the government spending. I talked recently about how over half the globe have been voting. So people who are trying to get into power don't cut the G part of it. It'd be suicide of making the hard choices before you go in. We're not. Everybody wants something in this world, don't they? Everyone asking for free accounts. So it's difficult. But next year, usually the year after, is when most governments try and rein it in a little bit. This is what Labour are trying to do, but they also need to get some spending plans through in their budget as well. We'll see how that plays out. But generally, a new government has to get everything balancing a bit at the start. Then X minus M, as I explained with Trump, can go a number of ways. Generally, you want to be exporting more than you're importing, because it's you're always at the behest of other people's prices if you're importing. I mean, the islands like the UK, etc., and people that don't have any big supply of base resources, etc., fundamental materials for building, have to import a lot. So that tends to create issues for them in various economic balances. Some of them will go through on a different area, but as Trump says, generally you want both of those to be growing, but the X bigger than the M, really, in terms of your own economy. So what would happen when debt crosses the limit in the US? Will they increase the taxes? Well, you can increase the taxes or you increase the growth, and hopefully a mix of both. Now, before I carry on with that, just in general, everything in economic data and fundamentals is a bit like I said, being on a gyroscope and trying to make it balance and go up and down, or think of it as something with multiple valves, or something with levers and things, or think like an organ where you're pressing pedals and pulling stops out and pushing them in, just trying to find a balance. None of this is easy, and looking at it in terms of one little issue makes things difficult. In economics, they use the phrase ceteris paribus. All things being equal, this thing standing alone works. But when you put it into the macro mix, which is the combination of all the micro factors put together, it's then very difficult. You're playing with a live dynamic machine. So just changing one or two things on their own and expecting it to change won't really happen. It's going to have an effect on something else. It's all about trying to work out which levers are going to have the most effects, positive and negatively, etc., etc. And then that's why we look at past graphs, trends, data, just like we look at past charts in technical form. There's technical charts within fundamental data as well, and that is something that is important to start looking at. And something I've always talked about, the rate of change of data, the second derivatives, as they call it in maths parlance, are often the more interest and more important than the actual data point themselves. So as we go through these data weeks, I always implore you to go directly to the source of anything that is released. So the BLS or the BEA, the S&P Global, the ISM manufacturing sites, they all have reports that you can read in all the data, all the inflation data, the jobs data, jolts, etc., initial claims, and it's all about seasonality and non-seasonally adjusted. So non-seasonally adjusted is the raw, real data, but because there are seasonal trends, then the economists have smoothed the numbers over the years and created these seasonal factors. So it's kind of, when you look at non-farm payrolls last time, it looked like it was really strong, but it's all due to a seasonal factor which put in a number of fictitious jobs to smooth the number. the biggest ever change. We talked about that on my preview 2 weeks ago. Something like 900,000 government jobs were created, and the adjustment factor was massive. And that was allowing for the fact we're going into fall, and summer jobs disappear and winter jobs come in and teachers go back to school. It's all about anticipating what the changeovers are. And yet in the real numbers, the non-season adjusted, there was actually a negative number on the month. So that is why when you come to the next 2 months, those numbers are looked at again. And because there are always surveys, people are answering them real time. But since COVID, a lot of people haven't been answering surveys. So this is why people are worried about the quality of the data. And often the first and second revision that comes through the non-farm payrolls of the previous months are the most important. And as you've seen, 90% of those have been revision ups. Be interesting to see if we now get a revision down now that the data started to reverse slightly. And the non-farm payrolls, they put in nearly a million adjustment down around the time of Jackson Hole, saying that they've been overestimating. So always look at the stuff, but try and dive into the detail below what makes up all these things. And each data point that I talk about going forward, we'll go and do that and show you exactly just how to look at those nuances, because that can often, just because the market's moved, it doesn't mean it's right. It's driven by people just looking at the headlines, and the real move will come later when you've looked at the full detail. Excuse me. So within this C plus I plus G plus X minus M, look at that. We are very much a materialistic economy in the Western world, particularly the US. Q2 GDP numbers running at 3% real. When people talk about real, that is, it was really running at 3% plus inflation, a nominal rate. So let's say inflation, as we know, was about 2.5% during Q2, and it came at 3%. So nominal growth was 5.5% over that quarter. Of that, 68% of all that growth was down to consumer spending. So it is really important to know what's going on in the consumer side of things and all the PCE stuff, the retail stuff. And you get a measure of PCE that comes out with the GDP numbers, and then you get the absolute tight, super tight, detailed data about a week later. But it's obviously lots and lots of clues every day and every week from the economy below. And then within that, services companies are basically 4/5 of the economy. So when you talk about ISM manufacturing and ISM services, really you should concentrate on what the services are saying. But because of the historic importance of manufacturing over the last century, so it's always had a big correlation with recessions. So even though they're only 20%, when ISM manufacturing is struggling, then that's what generally predicts a recession. But we don't seem to have that. We just got a slowdown. And everything has been spoiled a bit by COVID and the extra money that was spent. So it's kind of putting an extra buffer of free money into the system short term. That G number basically went up a lot, and they need to try and get it back into the bottle. So that slide there, which I had months ago when we were talking briefly about this, you see all those headlines. Core PCE is coming strong. Go and read the report. Non-farm payroll, what is that? Well, it's made up of 2 reports, household and establishment, which I say you need to look at them both, because the establishment one, the one with the NFP headlines in it, is the one that's had the big changes. The household one has been reliable, and that looks at various demographics within it and the unemployment rates and the numbers that are. Each of those reports has subcategory charts and graphs and tables that you can look at that tells you what's going on in various sectors. So it's really important to look at those, and then you can picture which of those factors should I be looking at. C plus I plus G, is it going to affect the overall situation? Because all of those are driven by other fundamental things. So interest rates are central. We said the bond market controls everything. If government borrowing is going through the roof, then there's an excess supply of bonds to pay for that. That means interest rates go higher. Interest rates are opposite to bond prices. Very good question coming through there from David. Is PPI that important? I see market not react that much to PPI. So CPI and PPI are quite related. They look at a lot of the same things. So often CPI, the end user, what the consumer's paying, is most important. But PPI effectively measures what companies are paying. It's the input prices that make up those goods. So there's a crossover of categories at times, and then you'll get a feel for where the price pressures are, whether they have to be passed on or not. So it's actually healthy for there to be CPI above PPI, but not by too much, because that effectively is the gross profit margin that companies will be making. So you want that to be moving at a controlled rate, not out of control. You want it to be positive, and that will tell you that the companies are growing, but inflation isn't causing problems for interest rates. Because if it's growing too quickly, then interest rates will probably have to go up, as we've seen, to control the inflation rate. So we want that sweet spot where the differential is not too much, because we don't want to be ripped off as a consumer, but we don't want it to be too small that companies are going bust. So there is a sweet spot, but that's always getting adjusted. Richie, why does CPI always have some manipulation in both directions before taking it? Are you talking about how the market reacts, or? But if you talk about the actual CPI, market reaction, well, obviously, the thing to look for as well, fundamentally, when you're looking at data and how it's going to react with the market, you need to know what the expectation is, and has anything changed from other data points that might feed such and such. So, yeah, remember, the way I look at it is that all the data is in there, and all the outcomes, all the betting, all the positionings are in the market, and we're looking to see who's spotted the trend quickest and who's got the most money dictating which way the technicals are going. So you are going to have people initially on releases reacting and not necessarily picking the right detailed nuance. So you often get, this is what I'm saying, what will happen in the real world, in the markets. Tons and tons of strategists and analysts and salespeople are diving into that data, looking for the sort of trends that I talk about, and that will change their outlook on, will that affect growth rates? Will it affect inflation rates? Does that mean that the prediction for where interest rates are going, is that correct, or does that have to adjust? And sometimes the headline looks like it's very hawkish and the rates are going to go up, but actually, if you look at the details, the bit that the Fed are looking at hasn't moved or has gone the other way. So, for instance, CPI last week, everyone's talking about it's a glitch, inflation's just popped up again. So why haven't we collapsed? There's been a little bit of to and fro in the bond market. They started worrying about the pace of interest rate movement, but yet indices have carried on moving up. Well, they're happy that it wasn't blowout, and relative to PPI, just what you said, we've got that nice little profit margin buffer. But if you look in terms of detail within it for inflation expectations, CPI, and remember there's 66% of core CPI, and roughly 45 to 50 of the headline is made up of the rent component. And most of that is made up of the OER, which is the owner's equivalent rent. So I've talked about this before, but if you haven't heard it, that's literally an estimate for what people who are living in houses, what they would have to pay to live in that house, just to try and get an overall view for what the rental prices are. And that has been very sticky. It's also lagging where house price inflation's been, and the historic for that is that if house prices have been coming down, then rents come down. And those house prices have come down and they've started to bottom, but we haven't had the fall in rents yet. We've had it slowing down a little bit. There's a potential for that component to hit zero, or if not, go down month on month. But within it, last month, not the recent one, the previous one, it came in above expectation at spot 5, and yet this time it came in at spot 2, even though the overall inflation rate was slightly above what the market expected. Now, to me, that's important because the Fed are really focused on the OER, and OER does appear in PCE, but with a lower weighting. So they know that the rental side this month into PCE is going to be quite subdued. So they're quite happy about that, despite a number of the factors that they don't look at within. So that is what we need to know. So therefore, the market, once it looked at it, decided, well, actually, that's not going to affect the inflation side of things too much. It's not going to stop them cutting rates, even though CPI missed slightly to the upside. There's still a chance that that's going to make PCE flat to, if not down. Does that make sense? So, you're going to get that flip-flop around data. There's a market saying around non-farm payrolls, the first move's the wrong move, and you often get that. It's just literally people see the headline and go bang. You get a lot of people, because generally you get a lot of people looking at it, and you get the big moves, and people are trying to guess which of the moves is going to happen and just want to try and nick a little bit of money up front. But the weight of money takes 5 to 15 minutes to really have a go. And then if it's really confusing, because you've got all the revisions to go through, the revisions often are more important than the headline, just to tell you what the real trend is. And it takes time to just work out those, which sectors were they in. So within those, what I've already described as made up numbers, the seasonal adjustment, all those numbers came through in hospitality and low paid healthcare workers, and in sort of education side of things, not in the real high margin, high wage, high intellectual property producing sectors of the economy. So even if the jobs were jumping, again, it's not an inflationary read, which again is why the Fed will think it's pretty much on the fence as to whether it's just bobbing along or whether it is strong. So, this is how detailed people literally get into it. So yes, people with more capital affect the market movement. The biggest guy in the room might be wrong, might be totally wrong, but if he's got the buy order, the market's going up in the short term. And it's for us to decide whether to feed him or not. That is the unfortunate thing. That's why, as good as I love technicals, I do. I was the nerd in the room when people didn't like technicals. We can't just rely on technicals alone a lot of times. Sometimes it is just a period where that is dictating, but often, and particularly when it's around data, it's going to decide whether people pivot or not. Then it does become important what the guy with the big order is doing, and if they want to move their price, they will. And if they want to sit where they are, they will. So that's either an order block in people's parlance or a accumulation and a manipulation. Manipulations do happen a lot in markets where you've got market makers. If you are dealing with someone who knows more than you, your only weapon is what you do with the start and the end of the orders. And often when you're in control of that order, you want to try and make sure that you make money out of the end of it. So you'll often say there's a sell order, and when that sell order is going to finish, the price will overextend before it pivots back up. And that happens a lot in FX and in stocks, which drive indices, as you know. So that is why you often get these very strange V-shaped moves, which is the AMD part of your ICT trading. But to me, that's that way I look at it. That is a wave 4 putting in a final wave down that then exhausts and pivots. These things all have crossovers in terms of technicals. Right, David, Bitcoin's interesting. We'll do a session on that because we can sneak it into Alpha Capital now, because you can trade micro Bitcoin on the Alpha Futures platform. But the key thing to Bitcoin, fundamentally, and it hasn't changed since setup, is it's a restricted supply. So on that graph we showed with the demand and supply, that supply curve will actually be a straight line up in the air. And interestingly, the other side of aggregate demand is aggregate supply. And when we talk about that in the long run, that supply curve is vertical as well, because eventually everybody's happy to supply a quantity at a certain price when everything gets to its maximum kind of productivity level. But so therefore Bitcoin, by definition over time, will have an upward lift to it because the supply available is getting lower. more, if you put demand up against a fixed supply, price can only go one way. It can just go up that vertical line, basically. It can only go up and down it. We're only going to have seemingly more demand for something that's fixed. If Bitcoin becomes widely used, then obviously that demand goes through the roof, and that was always the idea once it gets to sort of mainstream. And within that, there's a lot of things happening, aren't there? Because we've got people looking at gold. There's another secondary asset replacement for the dollar. And we've got the BRICS, potentially. They've got this unit coming. I go on about it all the time. But thinking in terms of Bitcoin, they're using the M-Bridge, which is the Bank of International Settlements blockchain. Bitcoin is blockchain. We'll not go into that at the moment. It's just a settlement system for those that are unacquainted. But basically it means that even for the BRICS, they are a centralized counterparty. They're people who can control your money in a centralized environment, and yet the whole point of Bitcoin was decentralizing, giving the power back to the people, taking away the chance of any manipulation. So why would you go and stick in a system which is CBDC, central bank digital currencies? Why would we accept trading still in a fiat system, even though it's backed by blockchain and central banks? It'll still be pseudo fiat, and so will the unit. Even though they're going to back it 40% with gold, which is a better option, going forward, people in the world have got to decide, do they want to be controlled by centralization, or do they want to have their money totally separate and be safe in the knowledge that it can operate in that safe blockchain system? So to me, I think the more that governments between themselves go down the blockchain route, that will make the people who are wavering on it think about it more, go and learn about it, and probably go, actually, I want to trade in Bitcoin, or whatever derivatives end up being the best one that survives. At the moment, that still is Bitcoin. It's all about making sure that the confidence is in there about the supply not being altered. So yeah, it's basic demand and supply as always with these things. We're trying to look at things in terms of the purest, no external forces, no externalities, as they call it, free markets. But as we know, in reality, every market has got some form of manipulation on the buy or sell side. And we'll look at those when we look at each individual factor going forward. But that's for another day. So interest rates, basically cost of borrowing for individuals and companies. Interest rates are made up of what they call the risk-free rate, then plus a term premium. Term premium is an extra bit that you pay in terms of creditworthiness or fear and greed portion. The risk-free rate is basically what you're more or less guaranteed to be paid. So it's whatever the government says. So whatever is being paid on the government bond. So if you want to borrow 10 years, your reference is the 10-year yield, and then there'll be money added onto that to reflect demand and supply factors at the commercial end and your own creditworthiness, etc., etc. So that you're always looking for factors that are going to affect that, and this is when you get the banking crises. And if the banks have to put more money in reserves because the Fed or whatever says that they're worried about their creditworthiness, that means that they've got less money to make extra return elsewhere, so they'll put your interest rates up. So your risk-free rate will have gone up. So it's how those different interest rates feed throughout the system, and then they become, as I said earlier, important for valuing prices of bonds. They're discounted by the interest rates. Future earnings of companies, they're basically divided by interest rates. If you make an equation 1 divided by an interest rate, then that gives you a big number. Every time that interest rate goes down, you get a bigger number, and every time an interest rate goes up, your actual worth, the number that you get out of the sausage machine, is lower, which is why you've got that inverse relationship. Interest rates go up, values go down, and vice versa. Inflation in terms of demand. And the reason we're looking at demand is, so we've got demand and supply. Ever since Keynes came in, the world has sort of followed his view of the world, the Keynesian world, which is demand driven. So he thinks that people produce goods to meet demand. Now, the other side of that has been, since the 1980s, there's been a lot of monetary policy because we had to respond to inflation. So that meant that monetary controls had to come in a little bit and people started studying that. But in general, we've now got a mixture. That's why I've got all these valves and taps. But I like to look at things in the Keynesian first. Where's the demand? And then we can look at where the supply comes afterwards. So inflation is really what the companies and individuals think. If they think that prices are going to go up and high inflation, then if you can afford it, you will buy now. And if you think that inflation is going to slow and come down aggressively like deflation, then you hold off purchasing because you know you're going to buy it later. So that creates an up and down effect on demand at the fundamental level. And the same for companies, they won't invest. And we've got that sort of thing with it's been happening in China. The reason they're doing monetary policy is they can't get people to invest because they think because all they're seeing is deflation, the prices are going lower. And we've now got the converse for the first time ever in the lives of the youth, and even the second generation in Japan haven't seen inflation until now. So they were never in a rush to increase their spending because they were scared of things getting more expensive. They didn't have to. There's not been any inflation. There's been this permanent flat line, if not deflation. So this is why they've been taking their time about putting rates up, and they've just started doing it because they don't want to squeeze it out of everyone. So wage price spiral. So you're gonna spend if you get high wages, and they've managed to get the firms in Japan to put their rates up, their wage rates up, way above inflation. So it's 4.5–5% last year. Adachi this week came out and said that they're going to take their time putting rates up again. They can look at the data, and they want this year's wage rise in Japan to be at least as much as last year. So they want to compound it. They want to get confidence into the consumer and into companies that they need to borrow because inflation is going to come through. And that is literally what they call a wage price spiral. That the more wages you get, the more you're going to chase the prices. Exchange rates, so that affecting that X minus M. If you've got a strong currency, then you can buy more cheaply relative of someone else's goods, and it's more expensive for them to buy yours. So although you want your currency to generally be strong, you don't want it to be too strong because it starts creating what we call balance of payments issues, and it also causes you demand issues. But Trump's not really that bothered because he doesn't really want to buy that many imports, and he thinks that they can survive with domestic demand. But he and his advisors won't want it to get really too strong, otherwise the fundamental demand will disappear. I don't think they can really sensibly get away with becoming a closed economy. It won't work, but they're just threatening that. And as I said, economic conditions, GFC, the great financial crash, COVID, I mentioned it. So with the Japan situation, they were the first into that. There was actual deflation in the system. And this is what China wants to avoid for the second time, which is why they're throwing lots of stimulus. People won't borrow at zero to actually get involved. C and I disappear, and it leaves you, the only way out of it is G. So even though people say that you shouldn't rely on the fiscal side of things and, we want to rein it in, sometimes you just have to, otherwise you're going to have a Great Depression. This is why, what's come out of what happened in the 20s and the 30s basically in the US. After they crashed, they weren't really in an economic realization of what to do, and they needed really to have pumped like crazy the G. So after a lot of experience, governments are really aware that they needed to bail out the system or it would implode. And that investment side of things really, really craters. People, what they don't realize is that when you've got deflation in a system, all that borrowed money disappears. People go bust, and that actually takes money out of the system. And this is something on the other side that we haven't touched yet, but the money supply. So if the money supply starts going down, you can, as a government, be doing QE or as a central bank, you're pumping money in, but if you're pumping in less than what's going bust, then you're still going to be deflating down. I always say, try and think of it as a big air balloon that gets a hole, and you're going to put a patch on it, but it's still leaking, and it'll only stay up if you're pumping more in than what is actually trying to escape. So that's how you kind of look at QE and try to balance the investment side of it. You need to make sure there's enough money in the system that people can still invest and have the ability to to invest and grow and make a business if they're in a position to do so. And COVID, again, what that did was shut everybody down. That shut down supply and demand of the economy. And so I've got a dog trying to jump in. So G had to come in massively again just to pump it up. But what really happened there was just a short-term bottleneck. Didn't really need much pumping up of the system because it would all come back, which is what we had. All we had was a supply side constraint. The demand was there, as we saw once we came out of COVID. So we created inflation out of the shutdown bottleneck, really. And then the Ukraine invasion obviously hit us a lot on a lot of the input sides of commodities and oils, and the way that the world has become quite polarized in its kind of global marketplace has made everybody no longer be self-sufficient. You're kind of reliable, and it's opened up a lot of bottlenecks in supply chains, something that going forward a lot of countries I think will be looking to address. And there you go. So does demand drive output? That's what Keynes says, or just making it first, which is the supply side, drive it. So I just want to go through those slides. I'm going to jump back to the document that's available to you all if you go onto my chat, onto that thread. Just lost the questions really. Cool, no questions at the minute. Right, what time is it? I know it's 3 o'clock. So we've gone through C plus I plus G minus X minus N. I've mentioned stuff there. So hopefully you get a chance to look at this and read through it. So you remember the UK economy is 2 trillion, but half of that is actual government spending. So, you want to try and get that lower. The question is, when you get the social politicians coming in, they tend to make that government side go up, which is that a good or bad thing? It's bad in terms of growth for your economy because governments aren't good at spending. They're not economically savvy. That's the whole point of business. It's people who know what they're doing, who maximize the benefits of everything. So you want your active side to be bigger than government if possible. That is why the Conservatives, when they come in, they're the opposite way. They believe in the free market. They want it to go the other way. So it comes down to the mix of tax raising and spending. So we call that fiscal policy, and that's important. So you now know, rather than it being a bore-off, just a political discussion, you want to be listening to the clues. You want to be hearing which parts of the economy Rachel Reeves is looking to meddle around in, help, or move away from, because we now know that is part of the GDP numbers that we're looking at. So keep that in mind. Now, obviously, wars are good and bad. It's never a good thing, people dying, etc. But it does jump up that durable goods number when it is a wartime economy. Then durable goods, defense spend, even though we like to look at that ex-defense, ex-aircraft, we know that overall durable goods spending, you have to keep an eye on what the total is, because we've got massive spending programs on weaponry, so that will keep the economy chugging. We're only using that as a proxy, the one excluding it. You still need to be aware of where the trends are. And the reason why everyone's worried about the debt side of the US, national debt in the almost quadrillions, isn't it? It's going crazy in the trillions. The price of that, with interest rates where they are now, is bigger to service that debt, is bigger than what they're spending on defense. Defense is their biggest sector by far. So they need to get that down, because it's obviously should be spent elsewhere, and it is effectively wasted money. So that all goes in the mix of the economy that's working as a drag on the G number. So yeah, sometimes I make sure you go and look at the GDP numbers when they come out, because we've talked about X minus M. Sometimes the GDP number can come in looking low, and it's mainly because the imports were big. China it's important to look at it in terms of China, because their consumer sector is really on its knees. They had decent-ish numbers today, but it's off a low base. When imports go up in China, it's generally because things are moving, things are being made, and there's big demand from their economy. Export-wise, we know they make a lot of goods. You expect their exports to be high, but the real sign when they're doing well is when their imports are up, and that in the actual equation can often make the GDP look lower because X minus M goes down. So that's why it's important to go and look at the details, not just the first headline number. So I touched on it. Aggregate supply is basically all the output in the system to meet that demand. But some people think it's the other way around, that the supply is made to meet the demand. And I think it's a balance. Don't take any of these things as a standalone. As I said, there's always levers pulling both ways. And certain sectors literally will be making a good that as much as they make it, it will be totally demanded. So I think NVIDIA, AI sort of stuff. Whereas others, well, even within that same sector we talked about earlier, others will just be making semiconductors based on what they thought was demand, and then that demand has disappeared. So it's a movable feast at any one time. Something to look at that doesn't get a lot of news play is productivity. The number does come out every month, and the US has generally been seeing good productivity. So that means we all do a little bit more per minute, per hour. We produce a little bit more for the same wage. Now, another big argument for why the US, particularly, if not other parts of the globe, are going to go banzai with the AI, is that making more and doing more, using more technology, is by definition increasing productivity. It's a secular change to the market, a complete new thing. That did happen in the 90s as we went into the development of the web, the World Wide Web, and then that turned into the internet and websites for companies. You know, people were doubling in market cap just by saying they'd created a website, into the crash of the 2000s. And the reason why we have to ignore a little bit of the comparisons with that at the moment is that most of these guys now are creating crazy amounts of money. Not only are they the biggest growing companies, but the biggest earnings, have got the most cash as well. Whereas back in the 2000s, hardly anybody was making any sales, never mind profits, and they were on ridiculous multiples of very low earnings. Whereas at the moment, NVIDIA, based on really good earnings, is somewhere like a third of Cisco, which was the bellwether back then. So there's lots and lots of potential upside for NVIDIA and the NASDAQ and S&P, etc., just based on that sector alone. And then the productivity gains. I talked earlier about how the bottom up of AI is doing well. So it's estimated by, who was it? The founder of Palantir, I think it was, saying that 40% of revenues of costs can be saved using AI just from process changes in basically what 40 trillion economy. So that's quite 16 trillion of potential productivity gains to be had over the next few years by the US economy. So it all lines up. Just try and move that over there. Hopefully we've still got people there. I haven't heard from you for a while. And then we keep talking about monetary side. So monetary side is literally the interest rates, and we hear about interest rates and inflation and yields every day. This all came from the Milton Friedman idea. Like I said, there's a lot of growth in this from the 70s and 80s as an idea. So money supply, literally what's in circulation. Good, thank you, Charlie. I will keep going. So the monetary side of things, literally M0 to M4, they're just all different measures of money supply. You throw different things in. M0 is called the monetary base. That is literally money in circulation, currency in circulation, and what you and I may have at the bank, and the banks have themselves, and whatever the reserves are at the central banks. So that's the basic bit. And then you throw on just other various instruments that have got less and less liquidity. So bank accounts, reserve bank accounts, deposits, money market funds, blah, blah, blah. And you move up that scale, and then it starts including loans and various provisional things until we get up to the M4. So, as I said earlier, the deflationary impact, once you saw the money supply contracting and going down, and once it got to deflation, then you knew that you had to have money literally created to plug the gap. That was QE. And then we ended up going too far the other way, and we've got so much more that they've been trying to slow it down. And then they've had to try and do that by putting the interest rates up. The interest rates slowed things down. They make it more expensive to borrow, but it also makes it a bigger incentive for people to put their money to sleep and not be driving prices higher. But it takes time, and interest rates themselves are a blunt instrument. You need to have other schemes taking place and incentives for people to invest in projects. And this is something the UK needs to do in the budget. They need to change the supply side, something that Liz Truss did and got criticised. And we could go on for hours about what happened with the delivery of what they were doing, but they literally, you need to get growth going by encouraging, I always say incentives are the big thing about the economies, and spotting opportunities in the markets is spotting where the incentives have changed. If you can see somebody do something that incentivizes someone to invest, then that is going to be a winner. Which is why you shouldn't really encourage people to fine the oil and gas companies. They should incentivize them to invest that money into renewables in the future and give them tax breaks. It sounds like you're rewarding the people that you should be that have had it so good for so long, but you need to change the world. You don't do that by punishing. People find a way of getting around that, or they go into something else. If you incentivize them, then you get much better returns. So we're looking for anything in the economic mix which shows us that there are incentives. I like that whole idea of game theory. Game theory problems generally are solved by the best outcome, the best compromised outcome. That's how the world really moves forward. If you just punish people all the time with no carrot and all stick, then you just get people running away. So you've got money supply, but money supply on its own isn't going to do anything. You've got money supply in China, but it's just sat there. In fact, their M1, the money that people have is going down, whereas M2, the money in deposits, is going up. Now they need to get more money into M1 so that people have more money, and then hopefully they put it to use in M2. At the moment, it looks like one is just swapping with the other, so people are potentially investing it in higher return accounts, but it's not going into the economy. So that's what's going on in China. You might look at M2 and think, oh, everything's rosy, but it's not. So they need to increase their whole money supplies because they are on the verge of deflation. So what does that mean? I've got two words here, phrases here: money multiplier and velocity of money. So literally, the money multiplier is we can take that amount of money and you want to borrow it from me. So if you're going to pay me, what are interest rates at the moment? I'll be generous. They're 5%, but I'll lend you some money at 4% because I want to help you, and you've got a really good project, blah, blah. So you take that money off me, and then rather than take the risk, you've got someone coming into you that's saying they can't get their money at the bank, blah, 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 and they pay you 5.5%, so more than you could get if you put it in the bank. So you'll lend it, and then they've got a friend who's probably slightly more of a risk than they are, and he's willing to pay 7%. So all of a sudden, that same amount of money has been lent 4 times. That's the money multiplier. We need to keep an eye out for that, because that generally, when the money's going around lots and lots of times, that means that the economy is working well. People are investing and borrowing. And at the moment in the US, there's an argument going on about the amount of loans and whether that should be seen as a worrying thing, because there's a lot of indebtedness. But actually, the serviceability of it, the money people have, and the fact they're employed at quite a reasonable level is meaning that that's a good sign. And corporates are generally cash positive, and they're borrowing at forward rates. The market has moved the rates to where they should be in anticipation of what the Fed's going to do. So it's cheap to borrow. They've got a lot of money for buybacks, etc. They've got good growth rates. So it's an absolute perfect storm for the business side, that I side of the US market at the moment. So that's the money multiplier. And then there's a measure, people want to measure how quickly those multiples of lending are going on. So again, GFC, those things, both of those collapsed as well as the money supply, reducing it and if not falling at times. So they're all things we need to look at from the supply side, because if you haven't got the money there to do things with, then the aggregate supply isn't going to take place. So it's all coming at it from the other side. In fact, that works on both sides, doesn't it? Because we want the companies borrowing, we want the individuals borrowing to buy the goods. So it's important to keep an eye on those money supply figures, even though it sounds like it's completely crazy. Governments, via their treasuries, so Janet Yellen, etc. in the States, they do things via working out, and you'll see it, often it's late night on a Thursday, and then there's the US Treasury website. You get intra-week auctions taking place, which is basically the government having to borrow money to fund their whatever it is they got through the House of Congress and Senate in terms of their spending plans. And the same thing will happen in the UK with the budget. They will then have to come to the market with auctions of bonds for people to buy. Historically, there's been a lot of people buying each other's. Everyone bought the US dollar. So China and Japan were massive owners of US treasuries. That was reserve currency that they needed to have to deal with people around the world. They wanted to have their money in something liquid in dollars. Now there's the option of having gold, and I've talked about that before. They run parallel, but you now need to own gold physically, which is why gold is up 30% this year, because central banks are literally buying it, owning it, and holding it locally because they have to. The market has changed since January 23. So a lot of the media just talks about gold in the old terms. They haven't actually realised that the fundamentals have changed since 2023, and there is now a massive incentive to own gold as a replacement to dollar assets. And in fact, if you think of it, gold is actually a dollar pair, so it's a double-edged sword for all these guys that are upset with the US. Not only are they buying a hard currency and a physical element by buying gold, they're actually selling the dollar at the same time. So they're getting a double whammy. But in terms of governments, you need to, there's a lack of confidence with the US government, that their debt's not out of control. So people are demanding a higher interest rate. That's why the interest rates go up. It's all about, when you're dealing with anything to do with loans, it's about the ability to pay back and the confidence you have in people's creditworthiness, and that now is starting to extend to countries. Someone like Argentina has always had to pay a big premium on their interest rates when they come to market to raise money, because they've gone bust so many times. So you're not going to lend them money at 5%, you're going to want 20%. It's just common sense. So monetary policy, you hear about it, that's interest rates, money supply, and various combinations, and how that then feeds through to valuations. Central banks, fiscal policy, governments and treasuries, tax and spending. That's the reason why you don't really hear Powell talking about government borrowing, really, because it's not his department and they should keep it separate. Janet Yellen, because she used to be the Fed governor, can't resist meddling sometimes. But it's often good when she talks, because obviously she's not handcuffed, because she's not part of the Fed. So whenever you see her having a speech, make sure you listen to it, or just scan it, search for what she said, because there'll often be a few clues onto monetary policy. So if you go through, and this is stuff that we'll go through in the next session. We'll go to these websites and show you how those figures feed through to all those data points. But there's a list of places to go: Bureau of Labour Statistics, the ISM site, Purchasing Managers, S&P Global, Bureau of Economic Advisors. You get GDP stuff from them. You get inflation and jobs from that one. You just go to central bank websites. So a lot of things, and there's really, really important one. The last thing we're going to look at in a minute is Atlanta GDP Now. I talk about it all the time. That's real-time analysis of where GDP will be based on every data release that comes through that affects that equation. That's C plus I plus G plus X minus M. So there is, one of the Federal Reserves is doing the work for the market, and a lot of my strategy economic friends looking at that as well. So it's becoming ever more popular. It is becoming referenced on the media sites now. We've talked about it since I was here. It's one of my favourites. And I implore you to, whenever you want to know what's going on and why things have changed, and we'll look at it and can understand why the Fed made the decision they did, because they take you through the changes literally one by one, giving you a reason what changed it. CME Group, great for the futures guys, but also, as you know, we want to be all over what the CME Fed tool's doing, what it's predicting for interest rates based on literal money buying of the instruments that measure federal fund rates. But there's all sorts of options and futures data in there. I look at that for deliveries in gold, so when you know there are physical buyers around, etc., etc. And then we want to connect it to that, the CFTC site that everyone looks at on a Friday night, the commitment of traders, the COP data. But do remember that is 2 or 3 days, that's a Tuesday night positioning, so it may even have changed since, but it's good for changing of trends, particularly if you're doing swing accounts, etc. But it's just one confluence. Don't rely on it as a direct read. And you're looking for changes really of which of the participants are playing. That's something else I'll go into in other presentations. That there's so many people involved. It depends which one. The fundamentals affect which one as to which kind of policy moving data is going to have the influence on the market. It can be the opposite one. And then there's a list of people I always think are great thematic people to give you an idea of what the big money players are looking at. So you've got Martin Wolf from the FT, John Authers was the FT, is now at Bloomberg, and you can sign up for him for free. Ambrose Evans, Pritchard, now he was always a bit of a Mr. Doom, but he's Mr. Macroeconomics, so he will always be all over something that the hedge funds are looking at. So good read, he's in the Telegraph. There's some good guys in the Times as well, I've forgotten the names. But anything, Economist, Shares Magazine, Investors Chronicle for themes, website Zero Hedge, the Globalist, that's got lots of strategists and top economic guys chatting. We used to deal with Capital Economics and Longview. You can sign up to those guys, but if you go on to Substack, Market Macro Hub, there's loads of people you can sign up to and follow, and you get some. I'm trying to do all this in terms of free information. We've also got Financial Juice as a product. Alpha Cap, you get real-time headlines, and some of those allow you to click through to some of the comments. Again, that should lead you to the actual websites that everything's about. Now, LinkedIn, again, that has loads of people, lots of charts, real-time reactions from people. You can follow me if you want. I follow a lot of what I think are the quite smart, cute, nuanced people. So that'll give you a chance of catching up with a few of these. And obviously, you can buy a very cheap, sort of £12 a month Bloomberg subscription that gets you access to most of their articles and data, and you can watch the Bloomberg if you haven't got it on one of your satellite feeds. Same thing with Reuters and CNBC. But you don't have to. And remember, with all those, don't follow what they're saying. And so it's all about. They will have bulls out in the blue and red, sellers out in the red, and it's about listening to the strategists' ideas and then using them to formulate an idea of where that demand curve is and what's happening on the monetary supply side, and build up the case. Don't just pick one and go, "Oh, that's a really good idea today." You've got to put it into context with what everyone else is saying. So they're always trying to play devil's advocate, bouncing these guys off each other, and do that. But make sure you keep try and predict, take a log of which are bulls and which are bears, and why they're saying what they're saying. And then I won't deal with what's at the bottom, so I've been going on long enough. But there's a really good question about which economic indicator is most important for measuring inflation, and how does that work for pairs, metals, indices. So you can either have a read of what I wrote as an answer, or we'll go through that next time. My LinkedIn account, you can just search for me, I think. Let me just see if I can find it. I've forgotten my link. Here we go. Public profile. LinkedIn. I used to, yeah. So within that, I said Fabo on my chat. He's very big on his fundamentals and technicals, and he subscribes to that. Yeah, you get the reports. So anytime, read one of those reports, and come onto my chat with any ideas. You can even send it to me for me to have a read, or pick bits out that you want to talk about. But I've spent a lifetime looking at those professionally, and I do write reports of my own, so I understand a lot of what's going on, so I should be able to help you. But it's brilliant. The more you can immerse yourself in it, you'll start to see the trends and the things that people look at and what becomes important. How's the Chinese economy going on? Can you explain it in the class? Well, the Chinese economy is literally on its knees. They're going for a lot of monetary policy bailout at the moment. They're trying to encourage people to borrow. They're even lending you money to buy the stock market, which means it's quite desperate. They're trying to get prices to go up, but they've got this engendered problem where people are worried about spending because they think things are going lower. That whole deflation side, people don't want to buy or don't have the ability to pick up the oversupply of houses that are in that economy, so they're going to have to keep bailing it out. So people really, they like the fact that the market bounced, but they said they want to see fiscal policy coming through. They want to see that property market actually bailed out with government money before they start investing, because they're just worried that the whole thing is going to keep falling down. They needed to try and make their exchange rate lower, and they couldn't really do that. They couldn't cut the rates aggressively until the US did, otherwise the differential between the currencies would have become too much. So remember the carry trades around the world, people borrow in cheap money by selling a currency so that they can invest it in another one. So they didn't really want to attract flows that way. But the problem is a lot of currencies are pegged against the yuan in Asia, so that creates lots of problems if they can't make themselves competitive. But China net is just above zero on their inflation rate. Really, it's not in a good, healthy position. They're not a million miles away from deflation, and if they still keep seeing debts written off in that property sector, like I described earlier, then the economy implodes because you can't print enough of it to go positive, which again is telling you that they are going to have to print enough. They're going to have to recreate that QE environment because people aren't doing the money multiplier effect in the economy themselves. They're hoarding their money. So this is what it's all about. It's about trying to create that velocity of money again that we just described, and trying to get investment, so FDI, fixed direct investment. If you look, whenever that gets released in China, keep an eye on it. It's been quite low. That is foreign people, overseas investors investing in China. That's not really been happening because you were getting smashed up in most instruments, apart from bonds. But again, they said people have created a bubble in that, particularly domestically. So they've actually stopped delivery at times of actual transactions. They're really trying to play hands-on of controlling the bond market rather than letting it have its own natural course. So that, again, things like that put people off investing in the country. So it's in quite a tight spot, and it's difficult to do. They had their 5-year plenum, their investment outlook, and they'd said they didn't want to bail out the economy as they had done previously. Well, 2 months later, they're back to square one, where they're already doing it monetary policy. It looks like fiscal policy coming next. Now, how does that help anybody? We need China to be literally moving. We need their economy to be building again. Industrial production we want up. Then there's a demand for the commodities underlying. That's good for the Australian economy, good for miners, good for lots of countries around the world. It's good for anybody that is reliant upon demand from Chinese companies for their goods. So that's very much Germany. Germany has a number one export market is China. So that is why they were struggling. Germany's now on its knees industrially, which is why Nagel, the Bundesbank, German central bank guy, has fallen on his sword, basically going, I will allow interest rates to be cut aggressively Germany are normally super hawkish because of their previous hyperinflations. So that's where you start to see the kickers through. That's why the DAX has been performing well. Chinese stimulus followed by European stimulus, and it looks like that's going to be big in itself in terms of rates, at least. People are forward buying the recovery in Germany, but woe betide if China doesn't follow through. I'm conscious I've spoken a lot. Hopefully that is a good introduction. Like I say, we'll go into each component of what I've talked about with graphs and data points and websites next time, unless you've got any more questions. But I do hope you like that, and come on to my chat, etc. Thank you, CK, Charlie Kendall, I presume.